Hello, everybody. Welcome to the webinar of LotusDew. LotusDew is a SEBI registered investment advisor and also a US SEC registered investment advisor. So we are a company that's licensed in two different uh, jurisdictions. And it's an interesting time given we are licensed also in US. As you know, US election results are due, and therefore there's a lot of anticipation. I have customers who are based in US as well, so they are watching the elections as much as we are all watching the elections, and it's going to be a pretty significant global macro event in terms of who takes the White House, what does that mean for global macro going forward. So on one hand, we have this the global macro where everything is connected. On the other hand, on the other extreme, we have things like listed venture capital, which is basically a way to democratize or make it more accessible venture capital like returns for retail Indian investors. And this is a way for us to present the upside of a venture capital, possibly in a packaged as a listed microcap portfolio, which also gives you the advantage of secondary liquidity. That's kind of what we are building towards. But in the webinar today, it's mostly educational. What I want to focus on is the fact that there's a lot of debate in the world, right? Uh, John Bogle started Vanguard, which was a passive investment house and which has been a passive investment house predominantly. And the question really is that do fund managers actually add value? Net of fees, are they? Is it better off being passive investors? So I'm going to actually argue in some cases you can learn a lot from passive indices, and it's of course an individual investment decision to figure out if you're getting value out of the strategy compared to what you get in a passive sense. And the agenda or the purpose of this webinar is to also open up the black box a bit in terms of how indices are constructed, what is passive, what is active, and what can you do passively, and where should you look for active investments, and what is the reason and rationale behind it. So without much ado, I just want to quickly touch upon the very basics of who LotusDew is and what we do. We are uh, a company that was founded by on the pillars of academics and practice as practitioners. So on the left is me. In the middle is Dr. Prachi Deskar. She's a professor of Indian School of Business. She's also an IIM Bangalore graduate with PhD from New York Stone. Her area of research is behavioral finance. My area of research is also behavioral finance, and that's where we kind of philosophically uh, agree on how to approach the market. We are guided by Samir Shah, who was the ex-CEO of NCDX, National Commodities and Derivatives Exchange of India, and he's been a mentor to us from day one in terms of giving us direction and giving us strategic advice. In this webinar, we are going to cover few things, right? Broadly, we want to cover. We know about few indices, right? We know about Nifty 50. We perhaps know about Nifty small cap, multi cap, mid cap. But did you know that in India there are actually more than 50, 60 indices that are available, and you can get the data for these indices. You can look at the constituents of these indices, and you can actually learn a lot about what NSE thinks about indices, like National Stock Exchange. So they are publishing many of these indices through their subsidiaries and partnerships. So there's a lot to be learned about what passive is before you can decide how to be active, right? So that's kind of the idea here. So the second thing we are going to learn about today is that can we, looking at how these passive indices are constructed, is there a way that we can construct our own active indices? Like, can we upskill ourselves when looking at passive to look at, well-researched index strategies to find how we can create our own active strategies and possibly even construct our own small case, which is what small case does is makes something, a technology like this, available to everybody. We of course use it to deliver active strategies to our customers, but as participants in this webinar or enthusiasts of small case, you can do it yourself, right? And I'm going to tell you how you can go about doing that in this webinar. So first thing, this is a bit technical. I mean, uh, somehow finance has a lot of Greek alphabets in it, because I think, ran out of English alphabets. But it is just to make things interesting. Typically, when you talk about markets, professionally, there are really two main things, right? Beta and alpha. And I'll explain what these are. And beta is essentially market return, passive return, right? Where, if you just are exposed to the market, you get that return. Active return, or alpha, is what cannot be explained by the market. So, which is unsystematic and specific to a particular strategy, where you are expected to deliver on top of what the market in an aggregate thinks to be is the expected return. And it comes really from another realm of technical mathematics called regression, where it's essentially we are trying to extrapolate the direction of the market by regressing it over its factors. And though markets are not linear, regression analysis is linear. And the difference why this still works is that in very small time frames, like in calculus, in very small time frames, things are assumed to be linear. And when I say very small time frames, though while in a long market cycle you'll have ups and downs, but in a very small time frame it might still look pretty linear. I mean, and that's also how calculus is based on, where uh, derivatives in calculus are assumed to work, because in small time frames or small changes in the value of the x-axis, y-axis is considered to be linear. So, but what is really passive, right? And is there really something called passive? Uh, I just want to kind of pause a bit and ask everybody. We say that passive indices, right? So why is it called passive? Well, actually, there's nothing passive, right? The moment you think you're active, because you're making a decision that you don't want to do anything else but follow that index. And what does that index following mean? It means that when you have a company represented in an index which has the largest market cap, that company is expected to do the best going forward, right? Otherwise, if that is the representation of that uh, value of that index in the total weighted average. So the very fact that we say we are a passive investor, we may actually make an active decision that just following the market cap of the stocks as they turn out to be during the phase of the index is the best way to capture value. And in many cases, it has been, and it has been the case. But in India, we have many indices, and especially in India, the indices are very narrow. So we have Nifty 50, which has 50 stocks, compared to S&P 500, which has 500 stocks. So the opportunity set of what is outside the index is much larger for an average, Indian investor, compared to what you could, for example, get in developed markets. And therefore, it's much harder also to beat indices in developed markets, because your representative indexes are so broad. Now, before I come to active indices, I just want to show you one chart. So these are all passive indices, by the way. So we have the Nifty Multicap, the Nifty 200 Quality, Nifty 50 Alpha, and Nifty 200 Momentum 30. These are all passive indices, but what I want to demonstrate is just being passive does not mean that you're a passive follower of market. You can passively follow factor-based indices. And just looking at Nifty, for example, there are various flavors of these indices which are passive in nature in terms of the rule set, but they have widely different returns. So just wanted to point out and explain that index construction itself is a kind of, requires a lot of knowledge and skills in terms of how you package an index. and what does that mean for investors. This is just a snapshot of all the different kinds of indices that are available in India. Unfortunately, only few of them have liquidity in the FNO space, where you have a Nifty future or a Nifty bank future, bank Nifty future, Nifty IT future. But in most cases, they don't have a passive replication or a passive, FNO market. So that is very interesting for retail investors, right? Because we have this treasure trove of information available in index construction, where we can construct our own indices, take ideas from these index constructions to understand how, for example, Nifty thinks about factors and so on when they're constructing indices. Just this snapshot, for example, we can look at various indices right from Nifty 50 priced in US dollar terms, which means what does Nifty 50 mean to a US dollar investor coming in as an FPI, for example, to using Sharia as a way to invest, for example, where Nifty Sharia indices offer Sharia compliant investment strategies, to multi-factor indices that you can just consume and construct, equal weight arbitrage sector like pharma, banks, and so on. So as you can see, there's a wide variety of index opportunities that is available to retail investors in India, and I think it's one of those hidden things that people can explore more to understand factor-based investing and so on. This is the sample hierarchy of the Nifty index family. As you can see, people are mostly aware of, if I would point the mouse, somewhere of Nifty 50. But as you can see, there are so many other indices that are actually pretty widely used, and funds are benchmarked. And why is this important? This is important because when you buy a fund, or when you buy a index, when you buy a mutual fund, or when you buy a small case, you have to ensure that the representative universe that is being represented is correctly benchmarked, right? So for example, think about the time when large cap funds held a lot of small cap, and when small cap was really outperforming. Then at that time, having a large small cap allocation in a large cap fund was a way to beat the Nifty 50 index, for example. But does that represent the real real way of stock selection skills, in terms of where you're actually paying that fund manager to pick your better large cap, and you can always go back and buy a small cap fund when you want to? So that's another decision that you can think of. But this is an example of the index family that is available to us. And there are obviously some rules associated to these index families. Things which are allowed are, the company must be domiciled in India. They should be, among the top 800 stocks in terms of turnover. They have to be traded daily in the last 6 months. IPOs can be included. What's not allowed is convertible bonds, foreign entities, and investable weight below 10% of free float. So if there's a promoter which has a large dominant holding, even if it's a very big company, and if the available free float for investable public is less than 10%, then usually that's not allowed to be constructed in the index. So I have a question. We all know that Reliance has gathered a lot of investments because of what their plans are expected to be with Geo. What do you think is going to happen if they spin out Geo as a separate company? Would that find place in the Nifty 50 index, or any other index, as a matter of fact? It depends, right? So what the usual rule is that if there's more than 3 months of history, even if it's a spin out, it can be allowed. So it depends when they spin it out. Indices are rebalanced every 6 months. So, if they want to be included in the index, they might, do a spin out at the very inception of the next rebalance, so that there's enough history and so on. But there's something to learn and watch out for. And finally, we come to a case study for a benchmark that anybody can follow. It's called the Nifty 200 Quality Index. So, Nifty actually publishes these documents where you can see how Nifty, for example, thinks about quality. What is quality in their eyes? So what you can see is that they construct an index where they use weighted Z-score, and Z-score is nothing. It's another way of statistically ranking companies. It's just as simple as that. But they take a equal weighted approach of return on equity, EPS growth variability, and debt to equity. And as you can see, which is interesting, is that for the z-score of debt to equity, the sign here is negative. Do you notice? So what that means is that when they look at quality, they look at high debt to equity as a negative. So for a company that ranks very high on z-score for debt to equity, that's actually penalized in the overall z-score as compared to normal other companies which do not have a lot of debt. So by definition, the way NIFTY, for example, thinks about quality is that it should be a company that has high return on equity and high, equity covering a little bit of debt, and their EPS growth variability should be low as well, which means that they should be consistent earners with high return on equity and low debt. And that's another way of constructing your own quality scores, for example, which you can put together. Other factors that NIFTY publishes where you can look at is for value, for example, they look at return on capital employed, P ratio, everybody uses almost, dividend yield, sales to price ratio. So kind of how many times the price of the stock are you paying for per unit of sales. So let's take, for example, if a company has $100 million in sales or 100 crores in sales, and the price of the share per share is 30 rupees, right? And for 1 crore of sales, let's say total number of shares in the company are 30 lakhs. So each sales per share is 1 crore divided by 30 lakhs, which is roughly 3. So price to sales and price per share, so that works out to be 0.1, 0.01, if I were to get the mental math right in a webinar. So with that said, I think that's another measure. So how many times the price, how many times the sales are you paying per unit price of the share? That's one factor. And then low volatility, that's really nothing but standard deviation of past 12-month returns. There's actually a NIFTY alpha index, right? So the NIFTY goes and actually calculates the potential alpha by looking at the average daily return of securities in the last 12 months above the 3-month MIBOR rate or the interbank rate for money markets in India. And then they rank securities based on that. So as you can see, there's a lot of information available where factors are processed. So obviously, given this so much of factor information available freely to be used, what does LotusDew do? How do we look at factors? Which brings me to the point, factor-wise or alpha-wise, what do you get when you invest in listed venture capital compared to all these passive and active factor-based passive indices that are available to be invested. So as you can see, we actually don't use any factor, like all the factors that I talked about. That's first point, because we have our own data that we track. And I'll try to show you that data, how you can access the data. We have made it publicly available on our website, and you can browse this data and do your own research to figure out other interesting opportunities, for example. And we only invest in stocks that are actually not part of any index. So any passive index return will not give you those returns or those stocks. So therefore we are very conscious of the fact that given that there's so much of a passive option which is available, perhaps which you can construct on your own or which you can buy off the shelf from ETF providers. When we construct a portfolio, we want to ensure that you get something which you cannot get cheaper or passively somewhere else. And that's my endeavor, and that's what we want to kind of live up to as a fund manager for your small case. So therefore, what do we do? Why are we kind of doing it differently than these factors? So the reason basically is these factor-based ideas and strategies They were cutting edge research back in 1990, and people have continued to research these factors in the last 30 years. And to a certain extent, a lot of these factors have been researched and milked out, and therefore, many of these factor researches, uh, either the research might not be publicly available, or you have to kind of start from fresh and do a little bit of work on your own, just instead of simply relying on a simple set of factors. So I think there's still value that could be articulated on these factors, but we decided to have a different approach where we thought, what is the most expensive asset that people have, and we think it's reputation. It's very hard to gain reputation back. It might be still easier to recover your losses, but reputation once gone is really tough. And therefore, we look for board members who are insiders of a company. We bank on the heuristic that the reputation is the last thing they want to lose, right? So we look for companies that have eminent board members who have standing, public standing, or have reputation to lose, and have lent their reputation to these small companies and also part of large companies, and they connected for professional reason. That's a great screen to identify a very, very tricky universe of small and micro cap stocks. There are 2,500 stocks that we scan, and we drill it down to less than 60 stocks where we start to do more fundamental analysis on. So this heuristic of how we go about selecting these scores so that we can construct these stocks universe is our edge, because we don't rely on external data. We have our own data that we produce, and I'll try to show that data as well, available to everybody, that you can screen through. And we use that data as a basis of our investment thesis. And finally, before we kind of move on to Q&A, NIFTY also very generously gives you a ready-made asset allocation index, right? So there's something called NIFTY Equity Savings Index. So what they do there is, it's 35% Nifty 50 total return, 30% equity arbitrage, which is essentially your cash market return, 30% is short duration, and last 5% is one day or overnight trade. So NIFTY kind of has thought about how asset allocation should be, and they have their own take. And if you follow the NIFTY Equity Savings Index, for example, you can do your own asset allocation to position your portfolio. NIFTY also has something called dividend points index. So as you can see, there's so many different kinds of indices that are available by NIFTY, which we can follow and we can learn from to understand how to think about passive and what really is active. And lastly, of course, the fine print. It's interesting that how regulators might be connected. So value inclusion, for example, what NIFTY does in terms of value inclusion, for some indices, they look for IRDA compliant dividend norms. So IRDA is the regulator for insurance, for example. So there might be insurance companies who have a dividend target for their portfolio, and value portfolios, for example, have to comply to this in the cases of some indices. SEBI, is a very advanced regulator in India. Morningstar does an annual, or I think every 2 year they do a survey of regulators across the world, and in that report that Morningstar produces, SEBI actually ranks 5th in the world in terms of how effective the regulator is compared to many other jurisdictions, which I think we should all be very proud of, given that our capital markets regulator is so advanced in overall ranking. And indices are reviewed every 2 times a year. So, there's a lot of oversight on this. As I showed you in the previous slides, liquidity is a very important factor to be included in an index, which means one thing you get for sure is that when you are invested in index stocks, they're most likely to be liquid. But liquidity is not always a good thing, right? So, liquidity gives you what it takes away from you. So if it's highly liquid and there's, a pretty bad news, as we saw with the case of Yes Bank, the value can be eroded very quickly because they're highly liquid and people are moving things very quickly. Illiquidity is a premium, right? So if you are patient with illiquidity, for example, you don't trade your houses every day. You're patient with the fact that once or twice in a lifetime you're going to trade a stock. of real estate that you hold in terms of your own property. And it doesn't bother you. But in the case of equity, when you are able to make such a decision, provided you're in the right stocks and good quality stocks that are backed by some decent research, liquidity can actually be your friend. Where if it's slightly liquid, that also means it you're happy to hold on to it, and you can see the accretion in value happen over a period of time as and when liquidity also increases. We focus on making sure that when we put together a portfolio, it's fairly liquid. We also don't like illiquidity that much, but given the universe of stocks that we look at, uh, especially in the microcap phase, it's not never going to be as liquid as a Reliance or a TCS, but obviously, it'll have liquidity constraints, and therefore it works beautifully for retail investors where they can move in and out very nimbly. And finally, thank you so much for staying with me for this webinar. I think I'm very curious to see what questions I can help you with. But before I do that, I'm just going to stop sharing my screen so that I can address the questions uh, better. And let me see if yeah. So um, yeah, so I'm just going to look for the document. So yeah, interesting, very good questions. See, this is the thing, right? Small case investors are not pure novices. I think that's what I keep telling everybody, that small case investors are actually fairly advanced or intermediate investors where they have done a few things on their own and they have finally decided to kind of work within the guide rails of, let's say, a small case manager or a investment advisor, where we hopefully can add some value to your personal execution capabilities and discipline, right? And therefore, the first question is that what is the best way to invest in an index? Well, there are two ways, right? There are funds, mutual funds that are index funds, and there are ETFs. So when should you choose one versus another? I think the way at least I look at it, uh, ETFs have bid and ask spread, but the advantage they have is that you can trade them intraday. Funds have one NAV end of day, and you cannot trade them intraday. So that's one difference. Second difference is that when you invest in funds, if you're buying more than 2 lakhs, you might get T plus one NAV. In the case of ETFs, no matter the amount, the moment you trade it, you get that bid price or the commingled bid price. So for amounts which are above 2 lakhs and you want instant exposure, ETFs could be a way to do it. Uh, Personally, I think that both options are good if you want to stay close to the index or you just want to be a passive investor. But as I said, that investing in index in India is still, I feel, a relatively suboptimal decision, given that there's so much of opportunities outside the index that are available. In US, for example, the median manager, so if you take all the managers together and you just calculate the median return, that actually underperforms the index. In India, the median manager outperforms the index. So what that essentially means is that just by being slightly active and so on, it's you're going to get above average returns as an active investor compared to a more developed market. I think the second question I already answered. I didn't see that question, which is better, index funds or index ETFs. The main thing with ETF is that you have to watch out for the bid ask spread. So if you're buying that index and the bid ask is wide, net of all bid ask and the expense ratio in the ETF, sometimes it can actually work out to be more expensive than buying index funds. But so that you got to watch that. It depends on the market conditions. It depends on the overall volatility. Index bid ask is always arbitrage opportunity for high frequency funds or strategies. So that got to be careful of that. How to differentiate between alpha and beta of a portfolio mutual fund? Please elaborate. Uh, so let's first talk about mutual fund. In mutual funds, I was a portfolio manager for a sovereign fund for many years. My job was also to select mutual funds, and to that extent, we I spent many years looking at what mutual funds or funds in general, how to select them, how to put them in a pension portfolio. Um, the benchmark of the mutual fund has to be representative of the portfolio. So that's the main thing, right? Um, if you find a fund, for example, which is benchmarked to Nifty 50, and they're only invested in small cap, that's not good, because if small cap is doing great or very poorly, that is going to misrepresent the information or the performance compared to what their actual benchmark is. So either they should change the benchmark to reflect the portfolio, or should they change the portfolio. So a mismatch of this is not a good good in terms of discipline of investing. So you should watch out for that. And whatever the fund earns above their benchmark, which you can find in the scheme information document, is what is called alpha. So what if I'm a passive investor and I don't have the I don't want to spend any mind share thinking about which stocks to pick. I'm just happy with a low cost suboptimal return in some cases. Go for a passive fund. But then if it's if your fund is not beating that, then there's a problem. So the excess return above a benchmark is called alpha. What do you think about Nifty Momentum Index? Is it wise to replicate the same in a small case? So see, momentum is a very interesting concept, right? I'm going to spend a bit of time here to discuss momentum, because momentum, is essentially a way of saying what did well recently is going to continue to do well. What did poorly in the recent history is going to continue to do poorly. Does it work? In real life, it does. I mean, people who tend to be good in something, they tend to be getting better at it, right? So good students make good grades and they continue to have good grades. Or, good sportsmen, sportswomen, they continue to, do well in sports. Artists, they, have momentum. Things have momentum, momentum is a way of life. So what's wrong with using momentum in investment? Nothing. I mean, the only problem is that we don't know what is the reason for momentum, right? If a stock is moving with high volumes and large price movements, it could be many reasons. The idea works because you just piggyback on that, right? We don't know what the reason is. We just follow it, but it doesn't always work. And the first documented research paper which is very famous is the Jagdish and Titman research paper in 1992. So people have been using this again like for last 30 years. It's like if you think about the technology of 1990s, that's what's based on. It works, but I think it's very difficult to make it work consistently. I mean, without taking a lot of unnecessary risks, right? So, thing with momentum is that you can't control the sector. You can't control, for example, the sector exposure versus a benchmark. So, you could end up in a situation where, let's say, in the recent past, IT stocks did really well, right? So, you're buying a lot of these IT stocks if they're showing momentum, and then your portfolio is 80% IT, right? So if something happens to that sector, you're basically running a sector fund against a sector neutral index. So the risk that you have in running such strategies is that, if your sector, if your momentum strategy does not catch that, turn in the sector weight or turn in the momentum, you could be holding a lot of stocks in one sector, which suddenly turns, and then if you're not moving it very quickly, or your strategy lags to find the signal, as you see our performance, you could quickly see very large amount of underperformance. So it works, but it is difficult, to do it without a lot of risk. Sorry, I'm not sure your product offering or Nifty strategy you talked about during your presentation. So I mean, of course, I am happy to show the product offering. I'll do that at the last bit. I think the main thing is I wanted to show you the data that we have prepared. Let me see if I can quickly do that. I'm going to share my screen again for a bit. And where am I? I'm just going to share my desktop. And let's see. So this is our website, LotusDew.in. If you come to this section called Explore, what you can see is that we have made this whole data available. So if I'm going to clear this out. And you can come here and do your own research about the data and the strategies we run. So one of the companies that I have in the small case is Rane Brake Lining. It's a small company. They make only one thing, asbestos-free brake linings for automobiles and railways. So अभी गाड़ी इलेक्ट्रिक है या डीजल है या हॉर्स कार्ट है जो भी है ब्रेक तो चाहिए ना. So that's kind of one premise, but more importantly what we can show you is that this is an integration with ticker tape, which is an offering from small case as well. So we instantly give you some of the basic price information and fundamentals information, and you can directly buy and sell through ticker tape. But look at this. This is what I was talking about. We track all these directors on the board of this, whatever we can find data on. And then not only we track them, but we can go on to find which other companies they are part of. So for example, this person, Rangarajan, he works for 13 other companies, and we can track that. And then we can go and see, okay, TTK Prestige, that looks interesting. They are connected. So Rane Brake Lining and TTK Prestige is connected. I'm going to look at who else works for TTK Prestige and who are the other directors there. And we can see, and we can go and start exploring other interesting people, and can look at, for example, Dilip Kumar, and then see where did he study. And we don't have information about his college, but we have information about other companies he works for. He works for Apex Management Consulting, for example. That's the data that we have. Then we can go back here, and then we can say, okay, what else can we learn about somebody else in the company? So can zoom in and out. But this is the kind of data, and we construct this strategy. And for this, we have LotusDew listed venture capital, and this is our strategy. This is our 1 month performance. We have outperformed the index. We index ourselves to equity small cap. This is our 6 month track record. This is a 1 year track record, and 2 year track record, and so on. So as you can see, it's the great thing about small case is that we don't calculate the performance; they calculate. So we can't fudge it. So if it's real, it's real, and therefore. Now stopping my screen share, let me go back to the questions. Okay. I would like to ask you, since you have experience from developed markets, do you think research that is conducted in DMI outside applicable towards Indian context? Very, very great question. I think, it's a very interesting question. Samir from Axis Bank, he asked this. Well, it's you have to understand one thing. So doesn't really matter, right? The fact is that there are enough developed market investors investing in emerging markets. So they are going to look at our equity and our investments from that lens. Similarly, academic research is global. So people tend to look at different global markets in the same way. So there's some sort of homogeneity where the factors tend to work in both markets. In India, for example, what has never worked really well is P ratio, right? Because whenever you find a stock that you want to buy, it always looks expensive. Different people have different reasons. My take on it is that people pay up for quality, right? And the fact that the P might be high, but they trust the management a lot. So then the trust is implicitly inbuilt in the high P, which perhaps you might get for a low P company, but you don't want to believe that the values so much or balance sheet so much. We know the different kind of controversies that arose because of 1% leverage, Yes Bank, Wakrangi, DHFL. These kind of companies, they had balance sheets, and then things evaporated uh, pretty instantly. So I think there's a premium to be had for companies that trust is implicit, and therefore factors that work abroad might not work exactly the same way. But ultimately, see, at the end of it, these factors have been researched and over-researched and again. So eventually, everything has a shelf life, and therefore, cutting-edge new research, AI ML based thing that we do, we think is the way forward, because we don't look at the same things. We try to find more upstream indicators or alternative data that we have, which is proprietary to us, as a starting point to find value. Uh, um, I'm just picking one question which I think can be going on next. Pushpraj asked about US election impact on Indian market. There is some, so um, here's the thing. Now, we look at gold, for example, as a hedge against inflation and store of value. But pre-Bretton Woods, 1972, where gold was the way currency was valued, gold had a very important aspect. Now, pretty much US dollar is the implicit gold, where whatever is priced in US dollar is pretty much even gold is priced in US dollar. What we think could be the case is that there are two outcomes, right? So, Trump wins or Joe Biden wins. Joe Biden has already talked about increasing corporate income tax in US up to 28% from, I think, about 25% on an average 22%. So that will lead to a direct EPS compression, which can be a downtick for US markets. But on the other hand, Joe Biden is expected to, spend a lot in government spending and uplift wages because he's a Democrat and, I think it's part of his agenda. So you have this interplay, whereas, if Trump comes, it's going to be continuation of some of the existing ideas and, central bank easing. So in both cases, what is expected to happen is that in US equity is still likely to get one sort of impetus or the other. For Indian, I think what really matters is really the Indian rupee versus US dollar, because it impacts our oil import prices and our current account balance. If you didn't, if you noticed, India actually produced a current account surplus very recently. India has traditionally been a current account deficit country. What that means is that rupee might strengthen, and if rupee strengthens, most of our large caps are net exporters. The revenue is net export, so that can have some sort of a headwind for large caps. Also, SEBI has recently said that they asked the multi-cap funds to rebalance away from large caps and into the right buckets. Again, another example of how style drift can lead to incorrect performance perception, because multi-cap funds should be holding all caps, but they largely were holding large caps because that did pretty well. So there could be a technical bid in small caps. So because of various reasons, I think, and the fact that small caps have relative to large caps has been the longest that they have underperformed large caps. There are a lot of things that could work in the favor of small caps in terms of including US election. That's my view around that. And yeah, I think at the end of it, what I would say is that there's nothing called passive. Everything is an active decision. Whether you put money in cash or you put money in passive index fund or you put it in a bank deposit, everything is your decision about your money. So there is nothing passive about investments. The only thing passive about investments perhaps could be that you feel that it's a rule-based thing and it's going on and you don't have to monitor it. But even when you invest in a passive fund, you're actively watching whether the passive is a good choice or not, right? So therefore, when you are anyways going to be active, why not do it more actively? I think there's still enough room in Indian markets for fund managers to be active, and hence I would say for as long as that's the case, I think there's plenty of room for fund managers to produce alpha for your money. And with that, I think I had a good interactive session. Thanks for all very interesting and thoughtful questions. Please do subscribe to the small case. We are running a special campaign where we are going to give out a discount code on our subscription fee for life. If you subscribe now with auto renewal, discount code is going to be LD30. That gives you a straight 30% discount on the small case subscription. And if you choose auto renew, it's going to stay and keep you at that discount percentage. But thanks for joining and thanks for spending your Saturday afternoon with me. It was a pleasure to be interacting with you and answering very interesting and thoughtful questions. Appreciate your time. Thank you very much.